You're listening to What the Sigma with Chad Stacks. Today on the show, the Federal Reserve just made a stunning reversal. 9 of 18 policymakers now expect rate hikes this year, a complete 180 from March when nobody did. And the new chair just blew up the playbook by refusing to submit his own forecast and axing forward guidance entirely. 9 of 18 Federal Reserve policymakers now project at least one rate hike this year. In March, that number was 0. Kevin Warsh, who chairs the committee, refused to submit a forecast of his own. Sit with that for a second. The chair of the Federal Reserve convened his first policy meeting, watched 9 of his 18 colleagues flip from 0 hikes to 1 or more, let 6 of those 9 go so far as to project 2 or more quarter-point increases, published the whole thing unmodified, and then walked into the press conference and said he didn't hear tons of conviction behind those very dots. The committee's own projections that he released to the world. That is not a contradiction. That is a strategy. Here's what actually happened yesterday, because the headlines are doing the story a disservice. Every front page is running some version of Fed turns hawkish. That framing is technically accurate and analytically shallow. The rate path is the distraction. The real move is structural. Kevin Warsh used his first FOMC meeting to begin dismantling the Bernanke-era forward guidance regime, and he did it in a single afternoon.
Walk through the evidence. The statement was unusually short. The language suggesting the next move was a cut got dropped entirely. Warsh announced 5 task forces reviewing how the Fed communicates, what data it uses, and how it evaluates inflation. He said forward guidance is not, quote, well suited to the current policy conjuncture, and then he declined to submit a dot, leaving the hawkish signal to come from the committee rather than the chair. Why would a Fed chair engineer hawkish optionality through his committee's dots while simultaneously refusing to own a forecast himself? Because he is not trying to lock in a rate path, he is trying to lock in a new communication doctrine. The dot plot, the forward guidance, the SEP projections. Warsh has been a critic of all of it for years. His view is that telling markets where rates are headed in advance amplifies the wrong thing. It gets markets pricing the Fed's reaction function instead of pricing economic data directly. That is a return to Greenspan-era opacity, pre-2008, before Bernanke turned the Fed into a communication machine. The market read it correctly, even if the headlines framed it wrong. CME implied probability of a 2026 hike went from 59.5% to 84% in a single session. The 2-year Treasury yield jumped 16 basis points, from 4.05% to 4.21%. That is not a Fed meeting reaction. A 16 basis point move on the 2-year in one day is a regime repricing. The front end is now pricing a world where every data print drives rate vol directly because there is no guidance buffer absorbing the shock. We will come back to what that means for anyone with floating rate exposure. The S&P 500 reversed a gain and closed down 1.2% at 7,420. NASDAQ off 1.3%. Microsoft down 3.8%. Amazon down 3.5%. Nvidia down 1.3%. SpaceX posted its first down day since its IPO debut, falling 4.9%. Nobody is writing about what that tells you about the rate sensitivity baked into the recent IPO cohort, but the number is right there. Now the inflation context, because it matters. Warsh is not manufacturing hawkishness for credibility theater. He is reading a 4.2% inflation print, a 3-year high, in an environment where the Fed has missed its 2% target for 5 consecutive years. May payrolls came in at plus 172,000, the 3rd straight solid month. The labor market is not giving him cover to ease. His own quote from the press conference: "We've missed on inflation for 5 years, and we're going to fix that." That is not a man reading from a political script. That is a man who looked at the data and made a call. Here is the part that is not getting covered. Warsh campaigned for this job last year as a dove. He cited AI-driven productivity gains as a reason rates could come down. In his first meeting, he debuted hawkish and said the Fed has been missing for 5 years. Meanwhile, economists are now flagging that semiconductor and computing investment, the CapEx build-out behind the AI thesis, is itself contributing to near-term inflation. Nobody in that press conference asked Warsh how his prior dovish thesis holds up against the very inflation that AI CapEx may be partially generating. That question did not get asked. And then there's the Trump angle, which the wire coverage treats as a footnote and should be treated as a variable with real uncertainty attached to it. Donald Trump spent 18 months publicly attacking Jerome Powell for not cutting rates. On the day Warsh debuted hawkish, Trump, speaking from the G7 in France, said, "We have a very good guy over there now, so I'm guided by what he wants to do." 18 months of pressure on Powell, and on day one of Warsh's hawkish pivot, Trump is guided by what he wants to do. Either there is private alignment between them that we are not seeing,
or Warsh has enough independent cover to run hawkish and Trump is strategically patient. The reporting does not probe this. It should. Back to the 5 task forces, because this is the buried story. A review of data sources and inflation frameworks sounds like bureaucratic housekeeping. It is not. If those task forces revisit how shelter costs, services inflation, or AI-driven productivity are measured, you are looking at a potential structural redefinition of how the Fed evaluates whether it is succeeding. That is a multi-year story with real consequences for every rate model on the street. Diane Swank at KPMG put it plainly. Warsh wants buy-in. He's not trying to change it by command. Task forces are how you build consensus for a rewrite. The 10-year yield moved 6 basis points, from 4.43% to 4.49%. That is the mortgage market moving. That is corporate debt issuance repricing. If this guidance-free regime holds, refi activity stalls further and the front end stays volatile every time a CPI or PCE print lands. The rate vol is not a one-day event. It is the new operating environment.
Matthew Lazzetti at Deutsche Bank said it directly. The risk that they might need to raise rates has clearly risen, given what we got today. That is a chief U.S. economist at a major bank saying the hike scenario is live. CME at 84% is saying the same thing in probability terms. What Warsh executed yesterday was not a hold with hawkish optics. It was a controlled demolition of the communication architecture his predecessors built over 15 years, using the committee's own dots as the demolition charge while keeping his personal forecast off the table. The genius of it, if it holds, is that he gets the hawkish signal without being accountable to a specific forecast. The risk is that without guidance, every print between now and September is a live event for the 2-year. The market just learned that lesson at 16 basis points a session. If inflation does not cool before September and Trump's deference runs out, the Warsh Fed will face its first real test of whether the new opacity doctrine holds under political pressure. That is the number to watch, not the dot plot, the distance between 4.2% and 2%, and how fast it closes.
What the Sigma? Follow our show if you want the alpha before everyone else. Nothing here is financial advice.
Grab news. Thomas.